Listen closely, because the liquidity event of the decade is happening right now. And if you are still looking at the geopolitical headlines through a moral lens rather than a transactional one, you are going to get slaughtered in the markets as the post-1945 order vaporizes into a raw arbitrage opportunity for those of us willing to trade the chaos. The structural rupture of the international system isn't a tragedy. It is a volatility spike that we can monetize if we understand that the so-called rules-based order was just a low volatility regime that kept risk premiums artificially suppressed. And now that the United States has decided to pivot from global policeman to predatory hegemon, we are entering a cycle of extreme kinetic realism, where the only currency that matters is leverage and resource control, which brings us directly to the breakdown of the Venezuela trade. Operation Absolute Resolve is not a law enforcement action. It is the most aggressive, hostile takeover in sovereign history, and you need to be looking immediately at the spread between West Texas Intermediate and Western Canadian Select, because the decapitation of the Maduro regime is fundamentally a play to secure heavy sour crude feedstock for Gulf Coast refineries, which have been starved of cheap inputs, forcing them to rely on Canadian imports. But with the Orinoco Belt now effectively under U.S. receivership, we are looking at a massive repricing of the heavy crude differential that will crush the margins of Canadian producers while sending the valuations of U.S. refiners with complex cracking capacity into the stratosphere. You need to understand the bond market implications here, because Venezuelan sovereign debt and PDVSA notes have been trading as zombie paper for years at pennies on the dollar, but this operation triggers a massive distressed debt arbitrage opportunity where vulture funds are going to swoop in to claim recovery values that could 10x as the U.S. Treasury effectively guarantees the restructuring of Caracas's obligations to stiff-arm Chinese creditors who are holding billions in useless paper. Speaking of Beijing, the seizure of Maduro is a direct margin call on China's geopolitical leverage in the Western Hemisphere, and we are seeing an immediate liquidity crunch for Chinese state-owned enterprises like Sinopec and CNPC that had forwarded billions against future oil deliveries that will never arrive, which forces Beijing into the spot market to replace that lost 700,000 barrels per day, driving up the price of Oman and Dubai benchmarks and squeezing margins for every industrial manufacturer in the Guangdong province. The immediate trade here is shorting Chinese industrial equities exposed to energy input costs and longing the U.S. energy sector, specifically the majors like Chevron, who are already drafting the engineering contracts to rehabilitate the decaying infrastructure of the Maracaibo Basin, because the U.S. didn't send Delta Force to arrest a drug dealer. They sent them to seize the collateral on a defaulted geopolitical loan. This moves us to the Arctic theater, where the ultimatum to buy Greenland is not a real estate deal. It is a hostile acquisition of the supply chain for the next century of warfare. And if you aren't long, rare earth processing and mining equities, you are missing the industrial decoupling trade of the century. The United States is effectively cornering the market on neodymium and dysprosium to close the GIUK gap and shut China out of the F-35 supply chain, which means the premiums on strategic metals are going to detach from industrial demand and start trading on national security scarcity metrics. The volatility on the Danish krone is the canary in the coal mine here, because if Copenhagen refuses the liquidity injection and forces the U.S. to do this the hard way, we are looking at a fracture in the Eurozone sovereign debt market, where the risk premium on European NATO members blows out relative to U.S. treasuries, because the market realizes that Article 5 is now conditional on whether you sell your assets to Washington when asked. This creates a massive arbitrage opportunity in the currency markets where you short the euro against the dollar, not because the dollar is healthy, but because the dollar is backed by the guys with the aircraft carriers who are currently seizing assets, while Europe is paralyzed by bureaucratic inertia. Simultaneously, we have to look at the Middle East, where the Saudi-UAE divorce in Yemen is creating a chaotic fragmentation of the energy corridor that threatens to spike insurance premiums at Lloyd's of London to levels that make the Suez Canal economically unviable for commercial traffic. The collapse of the Southern Transitional Council is the death knell for the Sunni monolith, and it exposes the fragility of the entire anti-Iran trade, which means the risk premium on Strait of Hormuz transits is woefully underpriced by the market right now. The so-called normalization of Red Sea shipping is a bull trap designed to lure liquidity into a kill zone, and when the next vessel gets hit by a Houthi anti-ship ballistic missile, the cost of war risk insurance is going to verticalize instantly, causing a supply chain shock that will rip through the global economy faster than the 2021 crisis because inventories are already lean. You need to be hedging against a resurgence of goods, inflation in Q2 2026, because if shipping rates spike due to a reclosure of the Red Sea, combined with the breakdown of the Panama Canal alternative due to drought, we are looking at a cost-push inflation spiral that will force the Federal Reserve to keep rates higher for longer, creating a massive headwind for duration assets and tech stocks that rely on cheap capital. The smart money is moving into the reinsurance sector because the underwriters who can price this maritime risk correctly are going to print money, while the logistics companies operating on thin margins get wiped out. This brings us to the macro endgame, which is the weaponization of the US dollar and the consequent flight to neutral assets, where gold is no longer just a barbarous relic. It is the only settlement layer that cannot be sanctioned or seized by the U.S. Treasury's Office of Foreign Assets Control. Central banks across the global south are dumping treasuries to buy gold, not for speculation, but for survival, which creates a floor under the gold price that technical analysis cannot see, because it is driven by geopolitical panic rather than retail demand. The bifurcation of the global economy into a U.S.-centric bloc and a chaotic non-aligned bloc means that cross-border capital flows are becoming perilous, and we are advising clients to repatriate capital from jurisdictions that might end up on the wrong side of the new Iron Curtain, because the U.S. has demonstrated with the Venezuela raid that sovereign immunity is a myth. And if you are holding assets in a jurisdiction that crosses Washington, your liquidity can be turned off with a keystroke. The trade here is to be long volatility, long the U.S. military-industrial complex, and long the commodities that are physically scarce, while shorting the intangible assets and the currencies of nations that rely on the old rules-based order to protect them, because that order is dead and the liquidation sale has begun. We are seeing a massive rotation out of European sovereign debt and into U.S. money market funds, despite the fiscal dysfunction in Washington, because in a world of kinetic realism, capital flees to the hegemon that can project power and guarantee the safety of the sea lanes it controls. This is not about liking the policy. It is about recognizing that the U.S. is exporting its inflation and its instability to the rest of the world, and if you are not positioned to profit from the dismantling of the global supply chain, you are effectively shorting reality. The disintegration of the Saudi-UAE alliance is particularly dangerous for the petrodollar recycling mechanism, because if Abu Dhabi pivots away from the U.S. sphere and starts settling trades in yuan or gold, it accelerates the fragmentation of the global payment system, which increases the transaction costs for every multinational corporation on the planet. The coalition of the willing in Europe is another flashing red light for sovereign risk, because it implies that Britain and France are willing to engage in direct conflict with Russia outside of the NATO umbrella, which creates a tail risk event that is completely unpriced in the credit default swap market for European sovereigns. If a French battalion gets vaporized in Ukraine, the contagion effect on European banking stocks will be immediate and catastrophic as the market reprices the probability of a wider continental war. Therefore, the portfolio construction for 2026 must be built around tangible assets, energy independence, and defense contractors, who are the primary beneficiaries of this new era of raw power politics. Do not get distracted by the diplomatic noise. Look at the capital flows, which are telling you that the world is rearming and deglobalizing at a pace that is going to shatter the efficiency models of the last 30 years. The just-in-time economy is being replaced by the just-in-case economy, which is inherently inflationary and capital inefficient, meaning that return on invested capital for global manufacturing firms is going to compress permanently. The only way to generate alpha in this environment is to aggressively trade the dislocations caused by U.S. unilateralism, whether that is buying the dip on Venezuelan bonds, seizing the arbitrage in broken energy markets, or shorting the currencies of allies who are about to be bullied into submission. This is a predator's market, and the prey are those who still believe in the sanctity of borders and the stability of treaties.